So you're starting a business and you're probably overwhelmed by all the choices from LLC, sole proprietorship, corporation, or partnership. I'm here as a CPA to explain to you and break down the pros and cons of each of these business types and who they're best suited for. I'll also share my #1 personal recommendation, and I'll warn you, my answer is a little controversial, so stick around. Hey there, I'm Noel Lorenzana, your friendly neighborhood accountant. If you're returning, welcome back. If you're new around here, welcome. On this channel, I'm all about making sure you don't pay any more taxes than you legally owe. I also believe that no one should be afraid of taxes or the IRS, and I personally think everyone should have access to a tax professional. With that being said, let's jump right in. So the big question is, why should you even care about picking the right business type for your business? Think of it like this. Choosing your business structure is like deciding on the perfect pair of shoes to wear. A flashy pair of wingtip dress shoes might look great with a suit, but they're not going to be much help on a hiking trail. Just like those shoes, your business type dictates a whole lot on how much you pay in taxes, who's responsible if there's a problem, and even what's best if you want to grow and expand your business. So let's go over the typical options. There are 4 main ones. You have sole proprietorship, partnerships, corporations, which includes C-Corps and S-Corps, and LLCs. Think of these as pieces in a chess game, each with its own special ability and of course, some downsides. Okay, first up, sole proprietorship. A sole proprietorship is a type of business where there's just one owner and there's no difference between the owner and the business. Here are some pros of a sole proprietorship. There's no formal creation process. It's easy to operate and then later dissolve if you needed to. There's no separate tax return required. The income and expenses are reported on your personal tax return. It's easy to integrate business use of home office deductions, and there's no double taxation of profits. So some cons. What are some cons of a sole proprietorship? Well, there's no liability protection except through insurance, so you're basically on the hook for all debts and legal issues. Self-employment tax is assessed on the entire net profit of the business. Self-employment tax is 15.3%, and this is on top of ordinary income taxes. Transfer of ownership can be complex. Basically, if you stop, the business stops. Limited resources. Often it's just you, so there's less time for money and for growth. So who are sole proprietorships suited best for? In my opinion, they're best for casual type businesses, side hustles, maybe freelancers, people who favor simplicity. Think of it this way. If your kid set up a lemonade stand at the end of your driveway and at the end of the day made a little bit of money, in the eyes of the IRS, they're considered a sole proprietor. Their income and their expenses, that is, if they're required to file a tax return, are reported on their personal tax return. Make sense? Okay, let's move on. Next up, partnership. A partnership is a type of business where 2 or more people own and run the company together. They share the money the business makes and also the risks and debts. Each partner is involved in the decisions and the day-to-day stuff, unless they agree to divide the work differently. So what are some pros of a partnership? It's a simple creation process. There's no limit on partner number or types. There's a flexible allocation of profit, loss, and distributions. And there's favorable tax treatment when liquidated. And for partnerships, there's no double taxation of profits. So what are some cons of a partnership? It does require a separate tax return, that's Form 1065, and you'd also need, presumably, a state partnership tax return. Partnerships have unlimited liability for all partners. Also, they're difficult to dissolve or change ownership without substantial planning. Also, it requires tracking of basis for the partners both inside and outside of the partnership. And lastly, the individual's partner share of income is subject to self-employment taxes. So who are partnerships best suited for? Typically businesses with partners not actively involved in the business, people who want to team up with a friend, family, or business partner. Oftentimes you'll see people who own real estate together. put the property in a partnership. Small to medium-sized businesses, individuals who trust their partners as each is personally responsible for debts and actions of the other partners. A quick disclaimer, I'm not a lawyer and none of this should be considered as legal advice. With the creation of a legal entity, you should consult with an attorney or online legal service, especially for the creation part of it. It's fine for accountants like myself and tax professionals to offer guidance on this, but in my opinion, since it's a legal entity being created, it's best handled by a lawyer or legal service. If you want to, you can use an online service like corpnet.com, who I recommend. Ask for Amanda and tell her I sent you. So next up, we have a C corporation. A C corporation is a type of business that's separate from its owners called shareholders. It can make its own money, pay its own taxes, and even get sued. Shareholders own pieces of the company through company stock. They elect a board of directors to make the big decisions. So what are some pros of a C corporation? Well, there's no liability for non-active stockholders. There's no restriction on ownership, and ownership can be transferred easily through the sale of stock. It's a separate entity from its stockholders, and you can also have fringe benefits for the owner officers. C corporations can also have ownership interest in any other business entity. They also have perpetual existence. Raising capital can be achieved by issuing stock. So what are some cons of a C corporation? Well, you have double taxation of profits, which you've probably heard about. I'll expand more on that in a bit. It's complex and expensive to create and maintain. It requires regular board of directors meetings and minutes, and it also requires a separate tax return, Form 1120, and also a corresponding state tax return typically. So who are C corporations best suited for? Businesses planning to go big or go public, companies that want to attract investors, business owners who want to protect their personal assets from business debts or lawsuits, companies that want flexible profit sharing among owners, businesses that plan to offer employee benefits like stock options, those who are okay with more regulations and paperwork, and businesses that don't mind the double taxation part of it. So basically, the corporation pays taxes on its income, and the shareholders pay taxes on their dividends they receive. So when you think of C corporations, think of the stocks that you invest in or mutual funds. Those are like Amazon, Google, Apple, and whatever. All those stock investments that you buy and invest in, those companies are all typically C corporations. So next up, we have S corporations. An S corporation is like a blend of a C corporation and a partnership. It lets businesses have the protective shell of a corporation, but it's also taxed like a partnership. That means no double taxation. The profits and losses go straight to the owner's personal taxes. So what are some pros of an S corporation? So you have liability protection similar to that of C corporations. There's no double taxation of profits, as I mentioned. Ownership is easily transferred through the sale of stock, and it's a separate entity from its stockholders. Also, self-employment tax is not assessed on the entire net profit of the business, and losses can offset shareholders' other taxable income. So what are some cons of an S corporation? They're complex and expensive to create and maintain. It does require a separate tax return, an 1120-S, and a corresponding state return in most cases. Requires regular board of directors meetings and minutes. It requires tracking of basis for shareholders. This is very important and often overlooked. Deductibility of fringe benefits for owner employees is limited. And there's also a salary requirement for owners. This is a big one. This is important. Those who own and work in the company must pay themselves a reasonable salary, which is subject to payroll taxes. So who are S corporations best suited for? They're best suited for small businesses that want corporate benefits without the double taxation, owners who want to protect their personal assets from business debts, companies with a limited number of shareholders, businesses looking for a simpler tax structure where profits and losses flow through to personal taxes. And finally, companies comfortable with meeting the specific rules to maintain S corporation status. So personally, I like S corporations. They're great. You can save a lot of money on taxes. My tax and accounting company is set up this way, but you have to understand there are many rules that need to be followed. As previously mentioned, you need to pay yourself reasonable compensation. You need to track your shareholder basis, and you need to have a full and complete accounting system in place. Next up, let's talk about LLC or limited liability company. An LLC is a business structure that gives you the personal asset protection of a corporation and the opportunity to be taxed as a partnership or corporation. The owners are called members, and as far as the IRS is concerned, it's a disregarded entity, meaning it's taxed by default as a sole proprietor if there's only one member, taxed as a partnership if there are multiple members, or taxed as a C or S corporation if you fill out the appropriate paperwork. So what are some pros of an LLC? It's a simple creation process. You have the flexible taxation, like I mentioned. You can choose how you want to be taxed, like a sole proprietor by default, maybe a partnership or corporation. You have liability protection for members. It's easy to operate and less paperwork. And you do have ownership flexibility. There's no limit on the number of owners, and they don't have to be US citizens or residents. So what are some cons of an LLC? Well, as you may have guessed, the taxes can be a bit confusing. The laws regulating LLCs vary widely across the states. And other. Refer back to the other cons based on how the LLC is actually taxed for some other reasons. So who are these best for? LLCs are great for the flexibility and they're easy to set up. You also don't have the formalities like you would have for the corporations, like board meetings and minutes for the board meetings. So my personal favorite business entity is the single member LLC. It gives you limited liability protection without the need to file a separate tax return. Now, obviously not everybody qualifies for this, but if you do, it's a really great option. Filing a separate tax return can be expensive, not to mention the burden and cost of having a proper accounting system to keep track of all the financial transactions. If you need help with filing taxes for your sole proprietorship or single member LLC, I do have a complete course, which after taking it, you'll be able to file your own taxes all without having to hire an expensive accountant. It does specifically refer to side hustles, but it applies to sole proprietorships and LLCs with only one member just as well. The link is down below in the description. There you have it. Choosing the right business structure can set you on a path to success or challenges. So pick wisely and consider getting advice from professionals like an accountant or a lawyer. Please share your thoughts with me down below in the comment section. I hope you found the video helpful. If you did, please consider subscribing for more content like this one. Thanks for watching and see you in the next video.